Let's just get right into it. Today, in this explainer, we are completely dismantling the myth that you have to stare at glowing charts all day to be a successful trader. Seriously, you do not need to be glued to a monitor. We're going to unpack exactly how you can extract consistent opportunities from the markets and do it without sacrificing your career, your family time, or honestly, your sanity. Look, we've all been there, right? So many of us are just desperately trying to juggle a demanding full-time career with the absolute chaos of the financial markets. You know the feeling. You're sneaking a peek at your phone under the conference room table, stressing out over an open position when you're supposed to be presenting a project. It's exhausting. It leads to absolute burnout. You end up performing poorly at your day job, and you end up losing money in your trading account because, well, your attention's totally fractured. But listen to me, it absolutely does not have to be this way. The market needs to fit into your life, not the other way around.
Okay, let's dive into this because this is the fundamental paradigm shift we need to make today. Intraday noise versus end-of-day calm. Intraday trading is that world of the 1-minute or 5-minute chart. It is frantic, it's incredibly stress-inducing, and it almost always leads to overtrading because you're just constantly reacting to every little blip on the screen. On the flip side, we have end-of-day calm. By shifting your focus entirely to higher timeframes, specifically the 4-hour and daily charts, you're relying on data that naturally carries a much higher probability of success. You're removing the emotion, drastically minimizing your screen time, and honestly, just finding a sense of calm.
So the magic number here is 30. 30 minutes. Or, depending on your specific method, maybe even just 15 minutes. That is the absolute maximum daily time commitment required to execute this highly effective evening routine. Just think about that in terms of your actual busy schedule. You don't need 5 hours. You definitely don't need some massive command center of 6 monitors in your basement. You just need one focused 30-minute block to calmly analyze the market, place your orders, and then, this is the best part, go live your life. It sets incredibly realistic expectations for what a part-time trader can actually manage.
Now, the crucial piece of the puzzle is understanding exactly when those 30 minutes should happen, and that is right after the New York close. Veteran trader Niall Fuller emphasizes this all the time. The official 5 p.m. Eastern Time close essentially finalizes the trading day, especially in massive global markets like Forex. By evaluating the market only after this daily candle has completely finished printing, you get the truest, clearest picture of the daily price action. Plus, there's a huge psychological relief here. You let the chaotic workday completely close out before you make any decisions. It literally filters out all those frantic intraday fakeouts that happen while you're busy at your day job. When you finally sit down after that close, you need a specific visualization process. Trading educator Lakeisha Tomlin puts it perfectly. You must zoom out first, then zoom in. Think of it like looking at a map. You have to start with the big picture structure. Check the weekly chart first for the overarching trend. Then, step down to the daily chart to mark your key structural levels of support and resistance. Then, maybe glance at the 4-hour chart to refine your view. If you start zoomed in on the tiny timeframes, you'll immediately get lost in the noise and start second-guessing your entire strategy. Zooming out gives you absolute clarity. Let's move to and see how this builds into a highly actionable 30-minute evening playbook. It's really just 4 steps. Step 1, scan those higher timeframe New York close charts to identify the dominant trend. Step 2, spot your specific, predefined daily setup. And hey, if it's not quite ready, just set price alerts on your platform. Let the software do the waiting for you so you don't have to watch it. Step 3, set your automated bracket order. And then step 4, which, let's be real, is honestly the hardest part for most people, walk away entirely. You go eat dinner, you go to sleep, you go to work the next day. The heavy lifting is totally done. To actually make step 2 work, you need absolute crystal clear rules for your setups. It requires straightforward, if this, then not logic. For example, let's say you're looking at a daily chart for gold. If gold drops and hits a really strong structural support level, you might look for Niall Fuller's famous bullish pin bar to reject that level before you even consider a trade. Or if you're trading Bitcoin and it's in a clear, aggressing daily uptrend, you might wait patiently for NetPick's 513 exponential moving average crossover as your trigger. And what if the market is just completely choppy or sideways? You do nothing. Having these specific, high-probability triggers totally prevents you from forcing bad trades when the market isn't giving you a clean signal. Stepping into the actual execution, we have bracket orders. Guys, this is the technological secret weapon for the busy professional. A bracket order is basically a preset automated instruction that you send right to your broker. It contains your exact entry price, your definitive profit target, and importantly, a logical swing-based stop loss placed safely behind market structure.
By setting all three of these parameters at the exact same time during your evening analysis, you completely remove the need to monitor the screen. If the market hits your entry the next day while you are stuck in a boardroom or out on a job site, the trade executes perfectly. If it hits your target or your stop, it closes out automatically. You don't have to lift a single finger. Which brings us to the ultimate psychological guardrail: set it and forget it. Once that bracket order is in place, you literally step back and let the market do the work for you. Over-involvement, or what we like to call meddling in your live trades, is hands down the single biggest reason part-time traders lose money. By stepping away, you remove your own ability to panic. You could literally be fast asleep while a massive Bitcoin move hits your take-profit target, entirely because you removed your impulse to close the trade early out of fear, or to widen a stop-loss just hoping a bad trade will turn around. And this brilliantly illustrates the profound importance of self-discipline. Niall Fuller really hits the nail on the head here. He says, trust me, the only thing you can 100% control in the market is you. You can't control whether the price goes up or down tomorrow. You absolutely cannot control global economic news or random market spikes. The absolute only thing you can control is yourself, your routine, your risk management, and your discipline to literally walk away from the computer. Accepting this total lack of control over the market while taking total control over your own actions, that is incredibly liberating.
So how do we actually exercise that control day to day? Through strict, non-negotiable rules. First, utilize a fixed percentage risk. Never, ever risk more than 1% or 2% of your total account on a single idea. Second, never move your stop loss once it's set. Moving it is just letting your emotions hijack your logical evening analysis. Third, focus on quality over quantity. Always aim for a 1 to 2 risk to reward minimum. And finally, and this is a big one, actively work to eliminate your chart watching addiction. Seriously, delete the trading app off your phone while you're at work if you have to. Limiting your physical control over live trades is what actually protects your capital from your own worst impulses.
Beyond those incredible psychological benefits, there is a massive, often completely hidden mathematical advantage here too. Intraday trading naturally results in a really high volume of trades. And you know what that means? High transaction costs. The fees, the commissions, the spreads, they quietly eat away at your account balance day after day, like 1,000 paper cuts. End-of-day trading, though, is a low-frequency approach. By taking far fewer trades and focusing only on those super high-quality 4-hour or daily setups, you drastically lower your transaction costs. This low-stress approach leaves way more of your hard-earned profits exactly where they belong, right in your pocket. Now, as you adapt to this routine, there is one final habit championed by experts like Michael Lamode and Niall Fuller, and that is keeping a journal. But listen, don't just track the numbers, the entry prices, and the setups. You need to track your trades and your feelings. Jot down if you felt anxious at work, or if you felt the sudden urge to meddle, or if you felt totally calm because you completely trusted your bracket order. Taking literally just 2 extra minutes to journal this provides an immense return on your limited time. It isolates the exact emotional triggers that cost you money, ensuring you continuously improve as a busy professional, even with absolutely minimal screen time. As we wrap up this explainer, I want to leave you with a really crucial question to reflect on. Take a hard look at your life, your career, your family commitments. How many hours per day can you realistically dedicate to trading without completely burning out? If the answer is just 30 minutes, well, you now know that is more than enough. You do not need to stare at a screen all day to be successful. The market should fit into your life, not the other way around. Thanks so much for joining me today, and I really hope this playbook empowers you to finally take control of your time and your trading.